Welcome, today we'll be reviewing 5 stocks which are trading near their 52-week lows in April. So let's jump straight into the first one, which is none other than Chipotle Mexican Grill. Now this company, despite having a pretty big rally last year, is down over 10% this year. And as we can see from their valuation ratios, their price to earnings and their price to cash flow ratio are the lowest they have been for the past 4 quarters. But one of the main reasons of why this price drop occurred is because this company had been trading at a very hefty premium for a while now. So the moment there are any market uncertainties or the company faces a small bump in the road, Wall Street is quick to overreact, especially with those companies which are trading at high valuations, which is something that happened to Chipotle. Now one thing to note is that this company does not pay a dividend. They use all of their free cash flow either to expand and open new locations or to conduct share buyback programs. Now, when we compare Chipotle's top line against the second quarter of 2024, we can see that it has actually decreased a little bit. And although this may be a bump in the road and may not be too big of a deal, when we look at their margin evolution, these have also decreased. Their net margin has gone from close to 15% to more in the range of a 12% net margin, which, when we combine these two effects together, we can see that their net income has actually decreased quite considerably in only 2 quarters. This could be one of the main reasons of why the market is justifying that Chipotle does not deserve that high of a multiple nowadays. However, I have a weak spot for this company, because when we look at their cash flow evolution, it is extremely predictable. They are incredible at generating consistent, stable, and predictable cash flows, which can of course have some missteps during the quarter, such as quarter 3 2024, but overall they paint a very clear picture that the company is a stable cash flow machine. And another point that goes into their favor is their balance sheet. They have a lot more total assets than total liabilities, and despite these increasing, their current ratio is still under control. Now, company number 2 is Target, which is in the retail industry. Now, this company has been hit hard and is down close to 40% for the past year, with no signs of slowing down. This is a different case because Target does not trade at hefty valuations. You can see that their price to earnings ratios are generally trading at around 15 times and their price to cash flow ratio lower at around 10 times. The market is anticipating the impact of tariffs and lower consumer spending. And as we can see, the stock price evolution actually matches and is the opposite as the dividend yield, which has risen and is currently the highest it has been, trading at a 4.23% dividend yield, which is very solid. And since Target is a pretty solid company, this actually makes me wonder whether this could be a good investment. Additionally, we can see that their 3-year dividend CAGR is a 3.8%. It's not the fastest, but it's stable and consistent. But what exactly happened? Because in the latest quarter, they had the highest revenues they have had from the past 4 quarters. And it does not seem too bad since their margins have been pretty stable. We do have to assume that the margins for retailers are extremely thin, which is why Target's margins being at around 3%, it's something natural. And if you look at other companies in the segment, you will find a very similar thing. Now, one thing I don't really enjoy about Target is that their cash flows are not predictable at all. You can see that they have some off quarters, some high quarters, and nothing can be explained because the net income has been pretty consistent for all the 4 quarters, but their cash flow has been all over the place. And this makes it very hard to judge whether the company can sustain their dividend or can conduct solid and consistent share buyback programs. However, again, when we look at their balance sheet, since their total assets are above their total liabilities, this gives us some security about the sustainability of this company. Now, before we move on, I wanted to tell you that all these graphs come from TradingView, and if you're interested in joining one of their premium plans, you can find a link for a discount down below. However, stock number 3 is Caterpillar. We did an in-depth analysis on this engineering equipment company, and we saw that this company is a monster. However, their price is down over 6% this year, and we can see that this stock even went on a rally after September 2024. So what happened? Well, again, since this is a very mature business, it doesn't trade at too high of a valuation, with the price to earnings ratio being at around 15 times and currently trading at around the average where it has been trading for the past couple of years. We can see, however, that this company has a 1.6% dividend yield, which has been growing at a faster 3-year dividend CAGR of 8.4%. And when we look at their financials, we can see that there is nothing that stands out as very negative. Their revenue has been quite stable, their gross profit has been very stable, and their net income has been even rising, because their net margins have been expanding since quarter 2 2024. So overall, this has been a very solid year for Caterpillar. And they are also a very consistent and predictable generator of free cash flows, as we can see from the chart. And I find this very interesting because this is a company which actually has high capex, They're developing and creating these huge trucks and machines. They operate manufacturing plants all over the world, and they're still able to generate huge cash flows, meaning that they have their capital expenditures under control. That is incredible. And again, when we look at their balance sheet, their total assets are above their total liabilities. Stock number 4 is Wingstop, which is in the fast food industry. And this company, despite having a very high growth rate, is down close to 40% this year. One of the main reasons, as we can see down below, is that they were trading at a price to earnings ratio of over 110 times. For a fast food company, that was incredible. However, don't get me wrong, they're still trading at a premium, closer to 70 times price to earnings ratio, which I believe is still a premium for a company. Now, this company only has a 0.45% dividend yield. However, they're growing this dividend at a 3-year CAGR of 16.7%, more than double Caterpillar's CAGR. And just by looking at their financials, we can see that their top line growth has been incredible and that their margins are rock solid. One of the main things that actually allows this is that Wingstop operates as a franchisor, meaning that they don't actually operate any of their restaurants. They have other people come in, create a partnership with them, and they just take care of all the operating business, and Wingstop receives royalties, which are very stable, very secure, and have low risk. However, they do have a downside, which is that it's very tough for their margins to actually improve from where they are right now. And this actually makes Wingstop be very similar to a company like Domino's Pizza, which also operates as a franchisor. However, when we look at Wingstop cash flow evolution, it's not as predictable as we would expect a franchisor's cash flow evolution to be. And now the main red flag that I have for this company comes from their leverage evolution, where you can see that their total liabilities are more than double their total assets, meaning that they have negative equity. Now, in some cases, this can be under control. For example, in FICO's case or in Philip Morris's case, they have operated with negative equity for a very long time and the companies are still thriving. However, I always suggest that before actually purchasing this company to dive deeper and analyze why exactly their equity is negative. And last but not least, we have Gartner, ticker symbol IT, which is in the professional services industry. They basically conduct market research and operate as an advisory or consulting firm. However, in the last couple of months, their stock has actually decreased to the point where it's now trading at over 10% down from last year. This is curious because we can see that their price to earnings ratio in Q1 2024 was closer to 50 times earnings, and now it's closer to 24 times. But what is the main reason for this? Well, it also has to do with the new administration of the US. With Elon Musk's department to actually cut expenditures from the government, a lot of these cost savings actually come from canceling most of the consulting projects that the government was working on. And a lot of these contracts were with Gartner. So these last couple of months have been a nightmare for this company because one of their major clients, the US government, has cancelled a lot of their projects together. Now, it comes without saying that Gartner, which is in the professional services industry, does not pay any dividends, so we can just move on. Following their fundamentals up until now, they had been growing quite consistently. Their top revenue looks good, and they even had a very nice margin expansion in Q3 2024, boosting their net income and delivering some amazing results. However, the expectation is that for the following quarter, their top line, their margins, and all the other financials will have deteriorated primarily because of the loss of a lot of major contracts. But we can also see that this company is great at generating consistent cash flows. They don't look as great as those generated by Caterpillar or by Chipotle, but these are very solid as well. And they do have the last point of their total assets actually being above their total liabilities, just slightly, but they have maintained this very consistently, which has made their current ratio be very stable and in a solid place. And having said that, thank you for watching. As always, this has been the Cashflow Compounder. Please join the free Patreon for extra content, and I will see you in the next one.